Hey folks, and welcome to this symposium on this beautiful Friday afternoon here in Bali. The sun is shining, the birds are singing, and the chickens are making some noise. I just wanted to spend a couple of moments to reiterate the whole concept of boxing, because it's a really powerful concept, and there are quite a few new members, and I just want to go over this just in case it's been overlooked by some of the new guys. So let's just have a quick look at that. Okay, so boxing is a concept that I started using a while ago to help me sit on my hands when I shouldn't be trading because price was not at an attractive price to buy, or if you're in a trade to sell at, or you want to short an asset to sell at. And so boxing is just something that I devised as a super simple way to help me be on the sidelines when I should be. And it's nothing complicated, it's nothing spectacular, it's just very powerful and very simple, which is why it's such a good thing to do. And so what I want to do when I'm doing boxing, I want to look for a very strong push in price, either higher or lower. Okay, and you can see here on this particular chart, this is the American dollar Swiss franc, where we had this area of supply here that was tested several times historically, and now price managed to move above it. Okay, and so here, the way that I would identify the swing that I wanted to use for the boxing exercise is I would grab a hold of the buy zone that was responsible for removing, in this case, the supply. And you can see it's right here. So this is let me draw this clearly. So this is where we had several attempts at moving beyond that, which we failed. And we managed to succeed from here. So this is the swing that I would use for this exercise. So I'm just gonna grab my Fibonacci tool. I'm gonna draw it from here to the high, like so. Okay, and so now I can see what's going on. What I like to do as well, actually I did that backwards. Let me zoom in. We can see our swing, it's right there. What I like to do is I don't actually do this every time I trade, but I can see it with my eye. What I need to do is I need to identify the two sides of the market that are the buy side and the sell side of the market, okay? So this is the buy side, and this is the buy side because this is the side of the market where we had the move, okay? So we have demand in here, okay? And knowing that, this also tells us that this is not demand. And what is it? Well, this is a reaction to demand, the demand being here, okay? So it's an attempt to bring our focus from reactions to demand to the actual demand, as you can see on the side, okay? And this goes back to the whole parent and child theory that we've discussed many times at Pipnotic, okay? And so whenever you see a really strong move like that, you should only be buying at price structures in this leg up, okay? Not all the way up, and I'll go into that in just a second, but you want to focus on the price patterns that you see in this leg up, okay? Not in any of the stuff that's on this side of the chart, because that would be the wrong thing to do. But what we can do on the other side of the chart is, if we just write that this is the buy side of the chart, well, if this is the buy side, then this must be the sell side, okay? So this is the sell side of the chart. So what that means is once price manages to turn around, so we start to see a nice move away from the high, then we can begin to look to sell at areas of supply that are formed on this side of the chart here, okay? And so you can see that we had a green candle. This is a very strong push below, and then we had a nice white distribution candle just here, and this is a child reacting at this parent, just here. So if we move those away, good Lord, you can see here that, here we had, let me have a look, here we had the supply, and here we had another child supply. And we know this is a child supply because if you if you focus on the detail here, price rallied, we distributed, we came down, we formed this candle, and then this wick here is essentially the slingshot and then the release. And so knowing that, when we can use the word slingshot, we know that this is the beginning of the sell zone. And so this is the cheapest price that we want to start to sell at once we have an area that's been created like this. Okay, and so knowing that we have the buy zone, the buy side, which is this side, the sell side, which is this side, you can put the boxes on there to make it easy. Then you can use a tool like Fibonacci just to show you where these areas are located. And what you want to do is, if you consider the order book for a second, where you have the top end of the order book, the bottom, wrong side, sorry. We have the top of the order book, we have the bottom of the order book. Okay, and then you would typically have big orders located at the bottom of the order book, and maybe there would be no orders here, or a very thin or gapping liquidity, gaps in liquidity, and then it would start to thicken up again once you get to the top of the order book. Okay, and so the whole point of using boxing and combining it with a visual tool such as Fibonacci is it enables you to focus on that order book concept. Okay, and so if we go from here to here, which is the sell side, remember, you can maybe draw this in there, we have buy side, sell side. Okay, and so we know that if price moves beyond this price point, which is the middle of the box, we know that this is a reasonable price for this asset. Okay, because we had the low here, which is responsible for moving the supply to the left. We went all the way to the top here, which is a very expensive price, it's a premium price. And so if price comes and dips down into the bottom half of the box on the buy side, or the top half of the box on the sell side, had we an opposing move, then we know that we are operating at a slightly more attractive price. Okay, and so if you want to look even further, you could even look towards the bottom of the box here, and here we have, oops, wrong tool, I do that a lot. Here we have the absolute bottom of the order book, and then here we have the top of the order book here. Okay, so this right here, this is a very attractive price to sell, and this is a very attractive price to buy. But we only want to buy because the move for the boxing exercise was a bullish. So it's a bullish box, not a bearish box, if you want to call it bullish or a bearish box. But we drew the box from a low to a high. Okay, so you only want to buy. Okay, so if we go like this. Okay, so what you want to do in a situation like this is, once price forms this high and then it starts to move away, and as you can see here, price actually formed a base here and turned around and went back to the sell side of the box and actually poked into this area of supply, and then it started to turn around. And what do you do then? Well, then the beauty of this is that now we actually have a new buy zone established, and a buy zone is simply a price point that the price is showing you where we had a turning point in price. You can see just here that we had a keen interest on holding prices above this price point. And so this is the buy zone, which lines up pretty nicely with the 62% Fibonacci. Okay, so this becomes the most expensive price you want to pay for this asset. Okay, so this is the place that you would expect price to come to, okay, which is just below here. Okay, you come to it here, and every time price does that and forms a new low, well, then you have a new buy zone, another buy zone. We had that one here. Price visited it once more, and now it came back again, and it went even deeper. So now we have a new one. This is at the 79% Fibonacci retracement. Okay, so each time we form a low, you don't want to buy at anything in here. Okay, you want to wait for price to move deeper into the box. okay, which it'll often do, especially when you have a price inefficiency like you have here, a very inefficient price movement. Because when you have something like that, you often will find that price will relatively easily be able to move back into this leg, because there is typically a lack of available liquidity in this move because of the speed that it occurred in. Okay, and so this is what we have here. And so let's do another example, or rather we can keep this example and we can leave these on there. We can just say that, okay, if we know that this is a very attractive price from this price point here to this one here, well then we can go ahead and we can do the same exercise, but we can do it on different swings. So now we tested super cheap prices for this boxing exercise. Well, now we can do the same thing, but for this one here. It's a little bit difficult because we haven't quite yet formed a top, but let's assume for a moment that we did form a top and price did something like this. Okay, then we could do the same thing again, and we could go like this. Okay, and then we have the exact same thing. And so we know that should price move beyond this price point, it's a very attractive, rather it's not an attractive price, it's a fair price for this asset. And it's a fair price within a very attractive price relative to the greater swing. And so when you move my t-shirt off the microphone, it got a bit windy there. So when you see something like this, you know that you are operating at a very advantageous price, which is down here, which is the 76.8% Fibonacci retracement, which is very, very deep in the box. And so you know anything beyond this price point here, which is the 50% or the midway box, sorry, the midway point of the box, you know that we have a super attractive prices there. And so you can do the thing over and over again, dependent on the swing that you're looking at. And so it's just a really good idea to do this on a bigger time frame, and then slowly work your way down to the smaller time frames. And until you reach a price point that would essentially mean that price was rebalanced, and you can see that we've done that here. And the reason I say that is because this is where we had this price point. You see, we had the area supply, tested, removed, and now price came back to it. So let me do this. I'm going to do this very crudely. And now price has made its way all the way back. So here you have kind of resistance becomes support. Okay, and this happened at very, very discounted price for this asset, just here at the 79% retracement for the Fibonacci tool. And I don't use Fibonacci in the traditional sense of the word, because all Fibonacci tool does, it enables you to see the degree of premium or discounted prices in a swing. And so prices don't automatically react to Fibonacci zones because they are quite subjective. I mean, I could have drawn Fibonacci from this swing, or this one, or this one, or this one. So why that one? And so while I say that it goes here, some other person could say, well, I think it should go here, or it should go from the absolute low. And that's true. Maybe it should go from there. But the reason it works is because all it's showing us is when we have discount and premium prices for an asset. Okay, so this is just a key point that I want to drive home. And so I made a video previously about boxing. And boxing, as I mentioned, it's a very simple way to dissect price. And as I mentioned, you can do it on big price swings, and you can also do it on small price swings. And when you have something like this, where you have a lovely area of demand just here, and this is demand, indeed demand, because it's micro demand, but you see we had an attempt to move above this area of supply here, which was tested, and it finally was removed, and it was removed from this area here. Okay, if we just kind of box off that whole area, this occurs at roughly the 79 or the 76.8 percent, or 78.6, sorry, Fibonacci level. And so this just gives us like a nice confluence. We have a very deep retracement. We have this retracement at an area where supply was consumed by demand, and so you have a handful of very profound reasons by which we could expect price to have a reaction at this price point. Okay, good. Well, I'm not going to go too much into detail. I kind of spilled over into a few different topics here, but I hope this concept makes sense. It's a very simple concept, but I think it's important just to reiterate that what you need to do is, when you're starting off, is you need to identify an important swing, and typically the important swing will be the one that consumed an opposing area of supply or demand, okay, which was supply, tested, removed. So we measured from the low, the buy zone, up to the absolute high, and this was the buy side of our chart, because we are seeing prices increase in value, not decrease. And this enables us, of course, to create the sell side of the chart. Okay, so we're buying on the buy side, we're selling on the sell side. Okay, so keep this in mind. If you have any questions, let me know. And thanks again for watching, and have a lovely weekend.